Well, welcome everyone, and thank you for joining this webcast. I'm John Nunziati. I'm an IR partner for Q4, having spent the past 4 years providing IR insight to Q4 clients. I'm an IR veteran with a couple of decades of experience in corporate IR roles, either as a member of an IR program or a leader of an IR program. And it's my pleasure to participate in today's session. I'd also like to thank the Q4 marketing and events team for their work in setting up today's event. And in addition, I'd like to recognize our partner Diligent, who's our co-sponsor for today's session. We're all quite happy to be able to provide this forum for discussion of such a relevant topic. And I'd also like to point out that all of Q4's webinars are eligible for continuing education credits and can support your certification efforts with NERI. As we look at the agenda for today's session, I'd like to highlight and remind you that we are going to be talking about the landscape for shareholder activism. It's rapidly changing and forcing companies to reassess their response plans. And with the advent of the universal proxy, changing economic tides, and new demands on boards and organizations, it's important that companies get ahead of any potential interactions with activists. So before we get started, I'll also remind the audience that we will be taking Q&A. So if you have a question, please submit that through the Q&A function on your screen. We'll try to incorporate those into the discussion as we move along. Now, today I have the pleasure of being joined by two experts on this topic, Valmik Desai from Salesforce and Josh Black from Diligent. They'll both provide a brief self-intro, but as I think you'll see, we should be set for a very comprehensive and enlightening discussion. So we're going to do some intros before we have Josh cover recent trends. Maybe Valmik, you can provide a brief intro and details on your current role, and then we can have Josh do the same before we get started into the topic.
Yeah, happy to, and thanks for having me, John. I appreciate as well just the partnership. I wouldn't call myself an expert necessarily on the topic. I definitely focus on all things investor relations here at Salesforce. I've been with Salesforce for the past 8 years. The past 4 have been on the investor relations team. During that time, we've of course had engagement with activists. We've also had a lot of other activity when it comes to the company transforming, acquisitions, leadership change, and all of it has kind of come to a spot where we feel really excited about the future of Salesforce. Of course, getting to this spot was quite the journey. So happy to share my experience and findings throughout the way. And I'll pass it over to Josh for his intro.
Hi, everyone. Thanks, John, for having me. So I'm VP of editorial here at Diligent. Most of my day is taken up by being editor-in-chief of Diligent Market Intelligence, our news and data service for all things shareholder engagement, including activism and proxy voting, and then corporate governance, compensation, and ESG risks. Some of you may know me from our predecessor companies. I started off with a company called Activist Insight, which became Insightia, which was then acquired by Diligent. And so very happy and lucky to be here.
Excellent. Well, thank you both. And so we can, Josh, jump right into maybe the recent trends that you've been observing.
Yeah, let me just grab control of the slides. It was a really interesting proxy season, and we were expecting it to be a really busy one. If you can cast your memories back as far as the end of 2022, the market had gone into a little bit of a meltdown. A lot of companies had falling stock prices. We knew that the universal proxy card was coming in as of September 1st. So we expected quite a big proxy season, especially with some of the pent-up demand or energy from the pandemic. And what happened was one in which there were a lot of different trends happening. There wasn't the volume of activism that we maybe expected. If you look at the number of contests that went to a vote on the far right side, obviously these are a minority of the overall activist situations. And this may have to do with the banking crisis that happened earlier in the year, remember that. But there were actually fairly few fights. What was interesting is that activists kind of won the majority of them, or won at least one board seat. And that was a trend that had kind of dried up over the pandemic. There was a lot more support for boards and management once you got past kind of 2020, when those fights were already in the pipeline and were pretty extreme cases if they hadn't settled already. So there's potential to kind of draw some inferences about the universal proxy card from that. We think that this tool will allow more activists to win at least one board seat, but may also have an impact in terms of activists winning fewer board seats overall, because it's a less all or nothing system than the previous one. What we think the biggest impact was of the universal proxy card was in making everyone rush to settle. I think no one really wanted to be a guinea pig for this new card. No one was quite sure how it would play out. So the majority of activist engagements, as they always do, went to a settlement. What was notable this year is that those settlements happened early and faster. The gap between a public demand being made and the settlement being announced was 67 days instead of 73 days, so an 8% decline. And a lot of industry players did cite the universal proxy card as a factor behind that. So kind of just changing tack to the demands, the type of things that activists were after in 2023. The fast rising interest rates have undoubtedly kind of brought forward the present value of cash and made long-term investments less attractive to some investors, including activists. And so we saw a lot of activists kind of looking for companies that had strong cash flow and the potential to turn those into dividends or buybacks or earnings per share. So companies that had been spending a lot on capex or on admin costs were among those that were more likely to be targeted, according to our analysis. And of course, stock price performance is always a very important determinant of what activists are looking for. Ultimately, they're looking for value and then a path to victory, and then a plan that will get them there. So just the overall kind of state of activism, we saw a lot more operational activism. There was a lot more focus on margin improvement, cutting SG&A, comparisons to peers in those regards. That was a really strong theme this year, and it was kind of mirrored by returning cash to shareholders. I think the two kind of went hand in hand. There was also a lot of focus on remuneration this year, a lot of criticism of executive compensation. Somewhat surprising in the sense that say on pay support was actually slightly up, at least for the largest companies. So in that sense, activists maybe were not quite matched up with the general investor sentiment, but made an interesting trend nonetheless. And I think the thing that was really down this year, that wasn't as prevalent as it has been in past years, is M&A activism, for obvious reasons. There were just fewer deals around, and that meant that there were fewer opportunities for activists to kind of get involved in either opposing deals or pushing for them to happen. So that was one thing where, we probably would have seen more activism overall if that market had been more open. So hopefully that sets the scene for the discussion to come. I can pass it back over to you guys now for discussion of recent experiences.
Thank you, Josh. It's an excellent summary, and I think it's interesting especially when you take into consideration the market environment and how that's affected some of the things that activists are looking for, and also then the impact of the universal proxy, particularly as we think about that going forward. So. Valmik, let's start off with you in terms of some of the things that you've experienced in terms of interactions with activist investors.
Yeah, I mean, I think taking a step back, as investor relations professionals, our role is to be the two-way communicators between the company and Wall Street. And the reason I say two-way communicators is you're not just providing your perspective on the strategy of the business, on the key goals, the operational metrics, and providing updates on how the company is progressing towards those. You're also really actively listening to the shareholder base, bringing that feedback back directly to the leadership team, to the board of directors, to ensure the investor sentiment and perspective is very well heard and understood within the company. Uh, when you have interactions with any shareholder, that's going to be your end goal. And that's no different with the activist shareholders that we interacted with. We want to make sure we were hearing their perspective, we're providing our perspective, having constructive dialogue, and bringing that exact type of viewpoint back to our board and our leadership team. And this is kind of a regular motion for us when it comes to the institutional shareholders that we interact with on a regular basis. Maybe it was a unique situation for Salesforce. I can't speak to other situations, but for us, a lot of the feedback we heard from our activist shareholders were very aligned to the broader feedback we've been hearing from our institutional shareholders. So, in that context, we already felt like we had a really good grasp of where the key points of consideration and some of the discussions were going to go, and we already had started working towards a playbook internally to address those core issues with the shareholder base and with the company. And we were able to continue to work towards that plan we had already laid out in order to remediate some of those relationships. So that's our experience here at Salesforce. I think a big thing for me is, activist shareholders are shareholders. You want to make sure that you're having the same level of dialogue, conversation as you are with any other shareholder. But you also want to make sure you're optimizing for the long term returns for the entire shareholder base. And that's really been our focus as we go through this process.
That's excellent. And I like the perspective of, activist shareholders are shareholders. I think often investor relations teams, especially if they haven't had interactions with an activist investor in the past, the initial reaction is to sort of, close the doors and try to bar the windows, and not necessarily engage. And often that's one of the most important things is understanding their perspective and gaining that insight about what it is that they see as a concern. Josh, anything you wanted to add there before I talk about a couple of examples?
Yeah, no, I think it's actually, I mean, taking that perspective of treating activists as normal shareholders is a great way to kind of neutralize their impact, because that is exactly what the activists themselves will go and say to the wider shareholder base. Certainly, the larger activists do a lot of research among institutional investors. There has been talk in the past about these kind of requests for activists that institutional investors put out, and I think that's probably on the decline now, but certainly they look for cues from other shareholders, whether that's kind of direct invitation or just selling pressure on the stock. The rise of kind of passive investors, how many active investors there are in the stock. And they position themselves as the friend and ally of the institutional shareholder base. And those situations in which companies have been kind of more resistant, have weathered a lot of pressure from shareholders and not been kind of responsive. Those are the ones in which the companies kind of get into more trouble, because it's much harder for them to demonstrate that they do listen to all of their shareholders. I mean, just putting in the proxy statement that you've engaged with an activist, that you've heard them out, you've given them an opportunity to present their thesis. That goes a long way to showing that you maintain effective governance and oversight.
That's an excellent practice that I think is probably one which many IR teams could adopt. Is really communicating the fact that they have done that engagement and gone through that process. And also, I think to your point about the interactions that that activist investors may have with your other shareholders. My experience, particularly one IR team that I was involved in at a high tech company. we had started to hear from some of our shareholders about concerns that addressed things like use of cash and concerns about the strategic direction. Um, and then ended up getting approached by Elliott Management. And it was very clear that they were sort of taking the position that they represented their own ownership as well as a number of institutions. And we ended up hearing essentially the same message from our number one shareholder. And it was clear that they had a series of discussions. They were asking for the same kinds of insight, the same sort of actions. And then when Elliott really did engage, management resisted, and it wasn't pleasant. Um, I had actually left the company before the campaign ended, but the end result was the board really did capitulate after a series of actions. The CEO and the CFO both ended up departing, and there were a couple of years that followed in a bit of strategic disarray as they mopped up the uh, the outcomes of that. So that they don't always have sort of easy resolution. I think if I compare that to a more recent example that we've had with a client where the client was approached by Gabelli and wanting to nominate new directors. Um, and we talked with the client a lot about discussing with management how they'd like to proceed. Ideally, that before an activist engages, you've set up that discussion about how, as a company, we will respond when this happens. Valmik, to your point about being able to engage and um, manage those relationships just as you would with any other top institutional holder. So I think if possible, it's important that IR does an initial call or an assessment to get some further details before putting management into a meeting with any activist personnel, and that's certainly what this client did. Um, but ultimately, that they did choose to meet and gather more information, and then management responded. So I think that this is one of the things where you do benefit by treating them as you would any other shareholder, and not necessarily as a threat. And then the last one example I'll share, and we can talk a little bit about other approaches, is um, another client approached by an activist. Very clear, we have a 7% stake, and they wanted to explore that the company should pursue a sale, kind of that M&A theme, and this was in the current environment. Um, Company sale rather than M&A might have been a little bit different, Josh, than some of the examples you had seen. But in this case, the IR team had already been monitoring the activists as a shareholder and had engaged with them in meetings, and so the IR team recommended that management meet with them, and they did meet. There were still some contentious discussions. Um, the activist went away and remained a shareholder. Went away in terms of sort of pursuit of the sale, but came back a couple of quarters later with some very serious concerns elevated to the board in a separate letter that went to the board about the stock transactions of executives, and highlighting that perhaps there was some questionable stock sales, and that was costing the shareholders. And their recommendation was to remove the executive, the CEO. So that one actually is still going on.
Yeah, no, we've seen quite a few multi-year campaigns by activist investors and situations in which activists were active at a company before the pandemic, and then more recently having kind of sold out the stock and then come back once the price dips to a similar level to where it was at the previous campaign, because these activists know the companies well, they have a big fat file on the shelf, and they think the valuation is off. And I think activists have certainly played the dislocation in the market recently. In some cases that's meant they've had to be less vocal and less active. They could get in when the market was overreacting and then enjoy the rise in the stock price back to something like fair value. I think the other thing is that activists do have a tendency to pop up at the wrong time. It's usually when you're in the middle of the difficult part of a transition or implementing a new strategic plan. They love to appear when a new CEO has taken over or there's a transition in leadership or on the board and try to exploit any gaps or hesitancy in planning. I think we saw that at several situations this year, and I think asset managers have shown themselves willing to back strong boards and management teams that are demonstrating good oversight of the not just the governance but the strategy of the company. But it does take a strong resolution to swallow the inconvenience of the timing and to be transparent as transparent as possible, at least, and to give the activists and maybe the market, some of the benefit of the insights that the company has about their position, their plans, and where it will lead them.
Yeah, it's helpful, this concept of kind of the timing of an approach. And Valmik, I'm interested in your thoughts on this. I feel like the insight for IR has always been, think like an activist. Look at your company, assess the risks, understand the performance and maybe any performance shortcomings. Know the relative valuation. Yet there's often sort of this sense of surprise when an activist approaches a company. I think in your case, you weren't necessarily surprised. Would that be a fair statement?
Yeah, I mean, for us, we had been hearing the same feedback consistently for the year prior, right? We went through a period of significant growth at the business, and we were really focused on building out our product portfolio, bringing out, a lot of new capabilities to our customer base, some organically, some inorganically through M&A. And some of those M&A decisions were really large sized deals that caused significant dilution to our shareholder base. And from a margin perspective, really plateaued us for a number of years while the top line was progressing well. And that situation where we were able to build out this great product portfolio, from a customer perspective, things were going really well. From a shareholder perspective, the profitability aspect of the business was just not performing to the standard that they expected of Salesforce. And we were very well aware of that, kind of going into the fiscal year planning prior. You actually heard us talk a lot about profitable growth and starting to lay out, a path to more profitable growth in the future. Amy Weaver, our CFO, onboarded, around a year prior to activist involvement, and her first investor day was really about, laying down the strategy of how are we going to get more discipline in our capital allocation decisions, how are we going to get a better path forward on margins. So we'd started to have the conversation there. Of course, we were still in a growth environment, so we were also investing in growth at the same time, and it was a much more balanced approach. And then a couple different things happened, right? One, we definitely had a different macro environment exiting the pandemic than I think anyone in software assumed, and we were hiring into expecting to see the same type of environment, the same type of spend we had seen, and that's not something we were seeing anymore. Two, we obviously had gotten to a spot where, from a profitability matrix perspective, comparing us to the peer landscape, we certainly had work to do. And then lastly, we did not have a formal, capital allocation framework around return of capital to shareholders since the company was founded. And we went live with a number of things to address those key areas that we had been hearing from institutional investors for some time when we went to our second investor day under Amy's leadership, and really started to address and lay out a framework of how are we going to address all these key areas and what's our strategy going forward. And then the macro continued to deteriorate, right? So things were kind of dynamic in the broader markets. And as a business, I give a lot of kudos to the leadership team on being able to adapt and being able to really accelerate some of these initiatives, given what we were seeing on the growth front, to really move quickly on margins. And I think that was very much aligned with what all of our shareholders wanted to see, including the activists. So for us, it was a quite unique journey. There was a lot of ebbs and flows in what we were prioritizing as a leadership team. But it was very clear when we got to the spot where, hey, we've been spending for a different environment. We're not in that environment. We certainly have work to do on margins. We recognize that, and we have work to do on capital allocation and providing capital returns to shareholders. We've been able to execute on all of those things. So margin from a non-GAAP basis this year, we recently guided up to 30%. On our share repurchase program, which we launched just a few years ago, or just a year ago actually, at this point, we've already repurchased $8 billion worth of shares, and we continue to focus on driving a more profitable growth path going forward.
That's helpful. And I think, and Josh, I'd be interested in your perspective on this. And maybe this is something that's difficult to measure, but the stance of being prepared and addressing things that Valmik, as you described, in terms of capital allocation philosophy, growth and profitability objectives, and the changes that you're making, so that when you are approached by an activist, you can say, we are already doing that. I'm wondering if perhaps the change in the resolution is a function of companies already pursuing some of the actions that activists might have otherwise brought to their attention.
Yeah, no, I think there is a lot of that. I think companies are generally a lot better prepared, a lot more responsive to shareholder feedback, a lot more thoughtful about the kinds of demands that were likely to be leveled. The reality is that activists exist, they're still quite well funded, and they need to find targets. So, in many cases, that means, especially for the larger ones, they're actually investing in really good, strong companies. And I think a balance of humility and acknowledging the work that you've done up to that point is really important, because the introduction of an activist may kind of force you to recognize that there is unhappiness in the shareholder base, and that things are building to something like a boiling point. But you can also take credit for your execution and for your track record. In the past, I was speaking to an advisor the other day, and I said, it seems to me that once an activist files a 13D, they get credit for everything the company does. Regardless of whether there's a settlement or a fight. It's kind of like, oh, that was the activists doing. Even if it was a pre-planned announcement or is very in keeping with what the company had been doing for the past year or so. And they said, yeah, there is some of that, and probably more so in the press, but investors have been there for a while, and most of them have, and they recognize good execution. And if they have seen the board and leadership kind of get out of tricky situations in the past, or have provided good leadership, have managed growth sustainably, then they are prepared to give the company credit for that, and that will ultimately hurt an activist's chances of getting into the driving seat. It does sometimes take a reflection that the tone of the delivery or some kind of concession needs to be given after an activist turns up.
Yeah, and I think the idea that an activist could come in and sort of change the direction of management and accomplish things or help the company accomplish things that they wouldn't have otherwise accomplished really does, I mean, it might be a stretch, but it does go to the idea of management credibility. Are investors aligned with the strategy that management has put in place, and are they comfortable with the timeline for execution, the pattern of execution? And Valmik, I think it sounds like in your case and in many cases of clients we've dealt with, that you already had many of the right actions in place, and then it was just a function of being able to show that you were executing and delivering to those, and then that accomplishes ultimately what the activist is looking for, and what most institutional holders are looking for anyway.
Yeah, I think a lot of it just comes down to saying what you're going to do and doing it, right? You're just executing
Yeah.
against what you've laid out and providing key progress updates towards your goals. Where you can outperform versus expectations, fantastic. Where you can continue to drive just a consistent approach and make sure that investors understand that this is part of the strategy going forward. It's really important because, to your point, from a credibility perspective, in a lot of these cases the strategy is slightly different than what they've experienced over the past 10 years, right? And for us, it's been kind of a 2.5 year journey now of trying to really educate and change the way our core strategy is perceived, in kind of the context of profitable growth and more disciplined capital allocation. So when it comes to that, a lot of it is, hey, you can say as much as you want about it and you can uh, talk all the talk, but until you actually show it in your numbers and show it on a continued basis, the trust and credibility isn't going to be there. And we've really focused on just kind of putting our heads down, executing towards the plan that Mark and the leadership team have laid out.
Excellent. I want to remind the audience, if they have questions, feel free to submit those through the Q&A. And there is one that I think, before we talk about some of the ways companies like Q4 and Diligent can help, maybe we can address this one. The question came in at a former company. We used to report out on extensive outreach efforts, particularly from a governance perspective. And the thought is that may have helped potential activists see the proactive efforts the company was doing. Do you think this is an effective tool, this report out approach? So maybe Josh or Valmik, if you have thoughts on that.
Yeah, I can jump in to start. At Salesforce, we do disclose kind of the percentage of our shareholder base we engage with on a regular basis through our proxy cycle. We have it in our proxy report. We also try and disclose the topics of conversation at a kind of a high level, that we're engaged with. I think it's helpful, but I think at the same time, you can engage with a lot of shareholders. If you're not taking the feedback and actioning it doesn't mean a lot.
Yeah, no, I think that's a really important point to make. I don't think it necessarily deters activists. I don't think they're the kind of core audience for that. But I think it's very useful in terms of communicating to the asset manager community. Obviously, they have to have received the request for engagement to believe it. But I think it's very important, especially if you have a proxy fight or you're trying to improve your say on pay or director election support, to disclose the steps you've made to solicit shareholder feedback. And certainly stewardship teams, proxy advisors do analyze the proxy statement and look for that kind of information. So it's well worth reporting out.
Yeah, I agree, and I think one of the things, the trends that we're seeing is that this type of reporting is becoming, Valmik, as you pointed out, becoming a little bit more detailed in terms of not only the number of shareholders that you met with or that you might have engaged with it in one form or another, but also the types of questions that often come up or the topics that come up. And this puts a burden on the IR team to be tracking that information throughout the year. One other thought important in this is not the type of sort of reporting metrics that you can turn off and turn on. I think once you've started down this path and provided that kind of information, you're going to be asked to continue to provide it. investors want to see the comparative. They want to see that if you're doing outreach, that you aren't, sort of reducing that at times when maybe the messaging isn't as clear or the performance isn't as strong, and increasing it in other times. So I'd encourage everyone to keep that in mind as they think about implementing this. But there are a lot of good examples out there, Valmik. I think we've cited your disclosure a number of times with other clients, and this is something that I think is going to become more and more common in most disclosures. Well, excellent. Josh, maybe we can move into a little bit of kind of how our companies can help. If you'd like to maybe touch base on that, and then I'll jump in with a few things from Q4.
Yeah, no, absolutely. So, Diligent Market Intelligence is a great resource for benchmarking your company's governance, compensation, ESG risk. We have a lot of profiles of companies and their peer groups that allows you to kind of understand where you sit in the competitive landscape, what your armor is, what your vulnerabilities are. And then, if you do have a shareholder in your stock that you are unsure about, whether they're an activist or, their support may be wavering, we provide detailed profiles that showcase their propensity to activism or to voting against management, with lots and lots of case history going back 10 plus years. And obviously Diligent, provides great board software. We've recently launched a investor engagement dashboard using some of the data from DMI to kind of report up, what your potential vulnerability to activism or to negative shareholder feedback might be to the board level.
Awesome. And maybe before I talk a little bit about Q4, Valmik, a question came in that you may be able to speak to a little bit in terms of the technology that you may use in the context of investor relations and any kind of activism, defense, or interaction. And then we can also talk about, I'll address some things in terms of technology that we think we can provide.
Yeah, I think a big thing for us, obviously, we're a CRM company, so using our own technology when it comes to CRM, tracking interactions, making sure we have every single engagement for all of our shareholder base logged inside of our own IR CRM app here at Salesforce, with the contact information, with the date, time, the key topics discussed. So all of that's kind of part of the process where, when we're reporting out, as we discussed in the last question, who have we engaged at what percent of shareholders have we engagement throughout the year? That allows us to do that reporting. And at the same time, it also allows us to see, who have we engaged with in our top shareholder base regularly? What are their perspectives, opinions? At a company of our size and scale, having just historic knowledge stored in your brain about what you talk to X shareholder about isn't always going to work. So that's one tool we use on a very regular basis internally. I'd say from another resource perspective specific to activism, just staying really in touch with whoever your surveillance partner is to ensure you're getting timely updates on any sort of movement in the stock. In a lot of cases, it might not be 13F filing type information, but precursors to that the surveillance partners are able to sift through and look at who could be driving some movement in the stock on any given day. That type of engagement was kind of a regular check-in point for us as well on probably a weekly basis.
Excellent. Thank you. Yeah, and I think from a Q4 perspective, we spend quite a bit of time when clients are asking about activism in terms of thinking about preparedness and having a plan in place, having an internal team and outside participants in that team identified. They may not necessarily need to be meeting or under contract, but you want to know that if you do need to convene that group, might include the CEO, the CFO, your general counsel, the head of communications, and potentially maybe even board representation. Often teams will include outside legal counsel or strategic communications. Josh mentioned some of the things that they can do. Valmik mentioned stock surveillance, market intelligence. Those and proxy solicitation. I think those are all viable outside participants, and having that idea of being able to pull together this team when needed is important. And I think, Josh, you also mentioned activist profiles. I think, from a Q4 perspective, we believe IR teams need to know, who are the most prolific activists, names like Elliott and Starboard and Value Act. But, you'd throw in a Third Point or a Trian or a Sachem Head, maybe a little less known sometimes. So, being able to provide clients with profiles and cross ownership summaries, any sort of campaign history, these are all things that are important at Q4. And I think when we talked earlier about understanding the risk and the relative performance, these are also assessments and analyses that we help clients with quite a bit. It's critical to be aware of the risks that exist out there and the potential shortcomings in performance that your business is demonstrating. And from an IR perspective, discussing those with management in advance of the interactions with an activist investor. And then I'll hit on the stock surveillance aspect, Valmik, that you highlighted. And I think from a Q4 perspective, the newest capability that we've implemented, engagement analytics, adds to this. Using engagement analytics, Q4 helps clients identify any sort of activist attention, and we've done this multiple times now. It might be through website visits or email alert opens, participation in your events. You may have activist personnel listening to your earnings calls or participating in your investor days without you even being aware of it. They may not have even contacted you. And we've had multiple situations where we're providing insight to clients in advance of those interactions so that they aren't taken by surprise by the fact that they might be receiving a meeting request or receiving a communication from an activist investor. So before we move on, anything Josh or Valmik you want to add to that, or any other observations from recent experience? All right. Well, Josh, I'll turn it over to you. You can jump in and talk a little bit about the 2024 perspective.
Yeah, so I mean, it is obviously still somewhat early to predict what's going to happen next year, but this is the time at which activist investors will be starting to make investments, maybe even starting to approach your companies. So this is a perfect time to put into effect all of the things that we've discussed, from the use of stock surveillance to being your own activist. I think there's a high probability that there'll be a continuity in terms of the demands that activists make next year. There are relatively few broad value levers that activists can use, and absent M&A, I think operational and returning cash to shareholders are going to be very high on the agenda. We sometimes see periods where activists call for companies to break up or do things like that. A lot of that market has been picked over, and I know that there are companies that are actively pursuing that and doing it without activist involvement. So I don't know that that's necessarily an opportunity that activists will find a huge amount of luck with. But the big question will be whether kind of M&A picks up, and if it does, I think that will lead to a lot of activism on all sides. The tricky thing about acquisitions or selling the company is that depending on the time horizon of your shareholders, everyone can have a different perspective. It can be something where if you're in the stock for 5 months, it's great to sell the company, you get a premium, and you can take that to your LPs. But if you've been in stock for 3 years, it may be selling at a relative low. So you could see bumperage where activists attempt to push up the price of the transaction. You could see activism on the side of the selling company. You could see activists saying that, instead of doing an acquisition, a company should be putting itself up for sale. So that is a moment at which it's important to have a game plan and a really strong communications game. And then I think with the universal proxy card, this was a test year. Next year we'll still be looking for insights into how it's going to affect proxy contests over the long term. A lot of the feedback from this year is that despite the proxy advisors saying, that the activists' case for change was going to be really important, that a lot of boards felt like they were only as good as their weakest director. And the ability of shareholders to pick and choose between directors is now a key vulnerability with the universal proxy card. So it's incredibly hard to get all the qualities that you need on a board, whether that's skill set, sector expertise, expertise in things like cybersecurity and even climate now, in just 10, 12 people. But making sure that you have the best possible board as a kind of prophylactic to activism, I think is going to be a key focus for a lot of companies.
Excellent. Well, thanks, Josh. I appreciate that forward perspective as well. I think one topic that we got, which I think we addressed a little bit, but it got an advance is, and the example is, I think, engine number one with mobile, where they put together, from a relatively, extremely small perspective, put together a pretty successful campaign. And that kind of highlights, I think, a concept of the wolf pack mentality. Do you feel that still exists now? Is that something that we're anticipating going forward?
In the sense of multiple activists kind of pushing in the same direction.
Yeah.
I think it does. I think it's not altogether common, and there are limitations on it in terms of how the grouping and the reporting aspect can work. If they work too closely together, they're required to form a formal group, and that raises restrictions on trading that are not very appealing to activists. So, in the engine number one situation, CalSTRS, which is the California Teacher Pension Fund, were very clear that they were aligned with engine number one, that they supported their push from the beginning, and that worked, I think, quite successfully. I think most institutional investors prefer to hear both sides and make their decision quite late on in the process. There's also some, reluctance to support settlements or to just resolve these issues kind of quietly. In some cases, I think institutions feel that it would be better for the fight to play out and for one side to have a mandate for a new direction for the company, rather than it being a side deal effectively. But I do think there are a shortage of really attractive activist situations, in part because of the work that companies have done, and that does lead to situations where you have 2 or 3 or even 5 activists, in the stock, and that can present challenges, or it can present opportunities. If you can divide and rule among the activists, then maybe you can get a better outcome than if you just had one activist in the stock.
Excellent. Well, I think we're getting close to time to wrapping up. Maybe both Valmik and Josh, if you have one piece of advice for IR teams going forward regarding activism, anything you'd pass on to them.
Yeah, I think constant communication with your shareholder base, your top shareholders, and making sure you're having not just one-way conversation on sharing updates on the strategy, but try and end every conversation with a question. Hey, what could we be doing better? What are your areas of concern? And making sure you keep kind of a list of those going on a regular basis, and bring those back directly to your board and your leadership team. Right, having that dialogue is always healthy, regardless of if you're going through kind of an activism engagement or not. So that's one thing that I think, for us, we try and do on a very regular basis, make sure that that voice is heard very loud and clear in the leadership room, and making sure investors feel that love as well.
Yeah, I think even going a little bit, I think that's great advice, but I think you can even go a little bit further and just say, know your shareholders. You can now build up a kind of case history of what they've done at other companies and how they've acted. And then you can take them at face value, but you can also have the benefit of knowing what their propensity to activism is, or their investment strategy or thesis. And that can give you a little bit of color into why they may be in your stock.
Excellent. Well, once again, I want to thank both of you, Josh and Valmik, for participating in the discussion today, and we really appreciate your willingness to share the thoughts that you have, and the insight and the experiences that you've been through. I believe today's call was quite helpful for our audience, as I think they will consider the potential for interactions with activists moving forward in the upcoming months. We hope that today's commentary helps each of you to ensure the success of your IR programs. And thanks once again to Q4 and Diligent for their support in making today's session happen. We'll look forward to the next opportunity for discussing best practices and emerging challenges. And until then, thank you all for participating.